Welcome to MacroHive Conversations with Bilal Hafiz. MacroHive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com. So greetings and welcome, Nick. It's fantastic to have you on the podcast show.
Thanks for having me, Bilal. Happy to be here.
Great. Now, before we go into the meat of our conversation, I do like to ask all of my guests something about their origin story. So it'd be great to hear your story. So, what did you study at university? Was it inevitable you'd end up in finance, and some of your key career milestones up until now?
Okay, well, my origin story really has two streams to it because my family history on both sides kind of intersected into this origin story. So there I was at Brown University. Realizing that I didn't like academics at all, in fact, early on at Brown. And so I spent a lot of time thinking about things for the next 2.5 years. And it turned out Brown was a perfect place for that because the academic requirements are so small at Brown. It's, you need 28 credits to graduate. You don't have to write a thesis, all of this kind of stuff. So I spent a lot of time thinking about where I wanted to go in life at Brown and sort of setting my guidance system, if you will. That was really how I thought about it. And the currents that I was trying to merge on my father's side was his success professionally. He was a very successful investment banker. I was raised in a very good lifestyle. I wouldn't call it super luxurious, but private school in New York, all of that kind of stuff. And I just couldn't imagine how I could replicate that. I really thought I was going to be the poster child for downward mobility when I was sitting there at Brown. At the same time, on my mother's side, she was an interpreter at the UN, a simultaneous interpreter, but more relevant to this story, her father was a noted a zealot, I guess is the right word, a proponent of an idealist is the right word. He promoted the idea of a political and economic union of the Atlantic democracies from his original post as a New York Times reporter covering the League of Nations in Geneva, gave up that job, which was a good job, moved back to Washington, D.C., and dedicated the rest of his entire life to promoting this idea. So I had this notion of, okay, how am I going to do well and do good at the same time in a way that honors all that I was given and all of the opportunity I had. I stumbled into it completely accidentally by getting a job at JP Morgan, also accidentally. They actually wrote me. I think Dad mentioned something to somebody there and they found me. I started at JP for 2 years. I was in their capital markets area. I was working on one of only 2 personal computers in the entire building at the time. This is 1982.
They obviously thought very highly of you to give you that privilege.
Yes, it was, I don't know what happened, but there I was writing code to simulate currency exposure on swaps. And I actually executed the first interest rate swap ever at JP Morgan with a Hawaiian oil refiner in 1983. Along came one of my colleagues in 84 who had been in Japan working in our very small securities subsidiary there. And he was quitting to go to Credit Suisse. And I remember tracking him down originally in the hallway and saying, tell them I don't want this job. And then immediately overnight realizing that that was a mistake because at 24, I should want that job and I should want to be paid to live overseas and get out of my comfort zone. And so that's what I did. And I ended up being in Japan for 4 years. I worked from 8 a.m. to 1 a.m. every day in Japan.
That's quite long hours.
Yes, very long hours, but fantastic business experience, the kind of thing I never would have gotten sitting in New York in a more traditional setup. And along comes 1988, and I see that JP Morgan has done this deal with Mexico. They've done the first loan for debt exchange in the history of these things. was the predecessor for the Brady bonds and the Brady Plan. And I looked at it, and all of a sudden, the penny dropped that here's a large area of finance with big problems for which JP Morgan is well positioned. And if you solve big problems, generally you do well. And if you work in emerging markets, you are, by definition, having an impact on the world. And so all of a sudden, all the pieces fell into place, Bilal. And that's how I ended up in emerging market finance.
Oh, that's excellent. That's a great story. And so you spent quite a large part of your career at JP Morgan to start with. And then after that long career, you were very sort of high up in the management structure as well at JP Morgan. You then decided to strike out on your own to set up the Rohatyn Group, or TRG, where you are today. You know, that's a big change, you know, to kind of, you know, you could just stay on, you know, working for big banks, you know, either stay at JP Morgan as a lifer or just move to another bank and just, you know, do that type of, you know, game, so to speak. But instead you decided to strike out and set your own thing up. So what was motivation there?
Well, you and I can compare notes on this, given that you were at JP as well, Bilal. The motive, it was a push and a pull.
Okay.
I left JP after the merger with Chase. So I had, as you say, I had gotten to really good spots in the hierarchy at JP, but that got very diluted the day we merged with Chase Manhattan Bank. So it really went from a management committee of 15 to a management committee of 50 with tons of overlap. And I had told myself for some time that if there were a fork in the road at any point in my career at JP, that I would want to strike out on my own and go back to the thing I love the most, which was emerging markets. Keep in mind that I only did pure EM for 7 years, from 88 to 95 was when I was building the emerging markets business there, which I built from 8 people swapping loans amongst banks to 600 people doing a proper, in 15 offices around the world, doing a proper capital markets underwriting, distribution, research, trading, etc. kind of business. From 95 onwards, I was managing other areas of the bank as well. On the trading side, I was managing currency trading, commodity trading, corporate bond trading for some time. Then I set up our fintech accelerator, and all of that stuff was interesting, but none of it was my passion, which is emerging markets. And so I had kind of set in my mind that was my plan B. And as soon as the merger came along, I knew that plan B was the likely result. It took me a year to work it through, to have the discussions internally, to make sure there were no flamingly good, obvious opportunities inside the bank. And then I set out on my own, and I had said to myself, okay, if I'm going to go out on my own, I'm going to do emerging markets. What kind of business do I want to do? I had been a sell side guy the whole time, right? A capital markets guy, but that business has huge barriers to entry, enormous requirements of capital, what have you. Buy side was a much easier thing to set up. And as a sell side person, I had observed what had happened to various buy side folks and what had worked and what had not worked. And so I built a business plan based around those observations. And the key elements were focus on emerging markets so I don't get distracted, invest across all of the asset class because everything relates to everything in emerging markets, have a business that is both local and global because you need both dimensions, build it on the basis of solutions, not products, and target institutional investors, because if you spend your career at JP Morgan, you don't know retail, believe me, all you know is institutional. And so I gave myself a couple of years to set up the firm, a bit of runway, and luckily I was able to get it off the ground.
Yeah, that's great. So it's funny you say after the merger, you that was a point for you to leave, and that was also the point for me to leave as well. I ended up going to Deutsche Bank, where I spent quite a long period of time. But then 4 or 5 years ago, I struck out my own with Macro Hive. So
there you go.
kind of, but in any case, the merger was a key sort of point of departure. It just wasn't the same for me anymore.
Exactly. Exactly.
Everyone's
It fundamentally changes the nature of the beast, right?
Yeah, absolutely. Now, I have a question on emerging markets. So, you started your career in the early 1980s, and so you've either been directly involved or been closely involved in EM over that period of time. What are some of the key developments or periods of transformation in EM that you've seen over that period of time? You mentioned Brady bonds, for example, or the first Mexico debt for loan for debt swap. Obviously, we had the tequila crisis, '94, Asia crisis, and we can sort of reel off all the crises. But in your mind, what do you think were the key kind of growth points or developments in EM?
Yeah, I think of sort of three inflection points. The first is what you said, the Brady Plan. So turning this defaulted loan only kind of environment into a proper capital markets environment. And in that, I also was the founding chairman of the Emerging Markets Traders Association. So we brought a lot of transparency, code of conduct, standardized documentation to the business of emerging market bond trading, and that helped to grow the pie. And that pie grew quite consistently from 88 to 2001. 2001, you have the dot-com bubble bursting, the world is in pandemonium, but emerging markets recovered relatively quickly, and 02 to 08 was then the second area or the second point in time where EM did well as a group. If you looked at emerging market equity returns, what have you, the currency was supportive, the markets were supportive, the countries had gotten the joke that hard currency borrowing exclusively put them in a difficult position. So you saw local currency markets, local institutional investment institutions being formed. It was a healthier point in time. And then you have the GFC of 2008, and that changed things quite a bit. Not really to the fault of most emerging markets. What it changed was two things, Bilal. One was it really set off this it accelerated the multi-decade directional trend of interest rates going down in the U.S. And falling interest rates, that multi-decade cycle of falling interest rates, has had huge implications on asset allocation globally to the detriment of emerging markets. Specifically, things with leverage in good economies did incredibly well. Secondly, things that were increasingly risk assets in good economies, crypto, venture, you name it, were favored over emerging markets. And thirdly, despite falling rates, because all of this capital was flowing to the US, the dollar was strong. And so you had weak EMFX. We have had a 15-year bear market in emerging markets since 2008, broadly speaking. That was one issue. Second issue was China. China was ascendant, has been ascendant for quite some time. But China really hoovered up the capital that was destined for emerging markets. So most international institutional allocators were perfectly comfortable satisfying their emerging market, scratching their emerging market itch by allocating to China, whether that was in equities or private investing. There is a statistic. I've also been the chairman of the Global Private Capital Association, formerly known as the Emerging Market Private Equity Association. There was a statistic, I think I'm right, that the few years before COVID, 90% of all private investing capital directed to emerging markets went to Asia. Of that 90%, 90% went to China. So 81% of all private investing capital went to one country. So that was the second big element in that post-2008 era. So that is era number 3. And I think we are entering right now era number 4. because these two things that dominated the last 15 years are changing. China is clearly a more complicated place for allocators to get their heads around. Plus, people are exposed. Second, higher rates translates in the other direction in terms of risk appetite, in terms of the US, what have you. So I think now we are just turning this corner where EM is going to start getting more attention again. And you see it in the way people talk about EM. You see it in the way people talk about, oh, okay, if China's complicated, what do we do about India? What do we do about the other large economies? What do we do about the supply chain and supply chain investing? Sort of, you name it. There are a lot of implications from these two very significant changes in the macro landscape.
And on China, presumably you must have been investing in China in different forms over the last 10, 15, 20 years. And the question I have is, I haven't done any direct personal investments or private investments there, but the impression I get is that there's quite a high level of opacity. You aren't sure about contract law there. Can you get your money out and in? And you're an EM specialist. So, I mean, how do you navigate those sorts of things with China? Because at some level, there's the tourists that just, piled into China, without, much sort of knowledge on those sorts of things. But someone like yourself or TRG, I mean, how would you try to access China given, some of these issues?
Well, we have had very little in China historically.
Okay.
It was not a big part of my history at JP, and it has not been a big part of what we do here at TRG because it is such a competed market and there are so many participants there. I think there are something like 10,000 private equity firms in China. Wow. That includes, a very large number of mom and pop shops, what have you. But I would give a generic answer, Bilal, whether it's China or any place else, or would have been Russia 10 years ago. There is a formula in all of these places, and it's a different formula in each place. The little experience I've had in China, in which we had taken over somebody else's portfolio and had to work it out. Actually, the court system kind of worked when we needed it to work. But in general, you have to have a formula in every country that reflects the structure, vagaries, what have you, of the country. And it always starts with local knowledge. You have to be local, particularly on the private side. It always includes relationships rather than contracts in emerging markets. Of course, you're going to have contracts, but relationships tend to be more important than contracts. Third, public market exits for the private investing world are fairly few and far between in emerging markets in general, even in China, I would say. And so trade sales and strategic sales are more important than public market exits. So you have to adjust your formula. Similarly, and again, I can't speak to China with any kind of authority on this point, that traditional developed market notion of I'm going to take a minority position, I'm going to defend it with contractual rights, and I'm going to get out in an IPO generally just doesn't work in emerging markets for some of the reasons I mentioned around relationships and IPOs, but also around minority positions. To your point, opacity. In emerging markets, people respect strength, generally speaking. Strength is reflected in an investment that is a control position or a position with significant rights. And that's the approach I think that one needs to take in EM.
And you mentioned other countries like India and so on. And this is one of the sort of never-ending questions of how do you define emerging markets? In your mind, I mean, do you have like a certain way breaking down EM by like Asia versus emerging Europe versus LATAM, or is it frontier versus developed? Or I mean, how do you think about EM?
I don't is the short answer.
Okay.
Well, I think anything that is kind of rest of world outside of G8 kind of qualifies. Of course, you go to Singapore, the last thing you think is that that's an emerging market. Same with going to Seoul, for instance. At the end of the day, from a business management point of view, from an investor's point of view, they'll give us money to do something we're good at, and they won't give us money for us to do something we're bad at. So if we have been in a certain country for decades and we know our way around and we can invest well, even if that country has graduated to investment grade, even if the per capita GDP is above X, they don't care, and nor should we.
Okay, and then you've mentioned private markets already. I mean, how do you think about public versus private when it comes to emerging markets, and why you look at private in the first place? When as you said, public markets have grown a lot. You have local markets have grown a lot. What does private bring to the table?
So the story on private markets in EM is that they get you access to the more dynamic parts of the economy because EM public companies and EM indices generally are tilted towards old industries, finance, oil and gas, what have you. And so if you want to have access to the consumer sector, if you want to have access to the faster growing parts of these economies, the private markets is how you do it. And the numbers bear that out. If you look at returns, private equity returns in emerging markets are higher than public market equity returns in emerging markets over the last 10 and 15 years. The issue there is that the world allocates on an asset class basis, and hence the world looks at emerging market private investing relative to developed market private investing, not relative to emerging market public market investing. Relative to developed market private investing, emerging market private markets have done very, very poorly. And that is because of currency risk, among other things. It is also because of the structure of the emerging market private investing universe. This is one of the things, though, Bilal, that I think, again, is now going to change. Higher interest rates are going to affect valuations and leverage on the developed market side. And the fact that we have less leverage in emerging markets, and that when rates start coming down, when we do have a turn in the dollar and EM currencies start performing, we'll have a couple of tailwinds in EM private investing. So I do think that, again, that turn is coming, but it is this allocation issue and the way the world thinks of things in these vertical silos that has been such a difficult hill to climb for emerging market private investing.
I mean, do you think through education, asset allocators would think about, this differently, so they'd put private and public together under EM rather than trying to compare it to DM?
I think there are two elements there. One is, you mentioned China and all things ex-China. This is a big topic of discussion now in the investing world. And what's happening is that the large firms, the Blackstones, the BlackRocks, others of the world, by necessity to a certain extent, are talking up India. They're talking up Brazil. They're talking up Vietnam. They're talking up the rest of the world. And this is having an effect on how allocators think. When the big brand names start talking about stuff other than China as EM, and hey, there's stuff going on here, that is educating investors about allocating to emerging markets in general. This issue of investing, of comparing public market EM to private market EM, I think that's going to be a tough one. I just think the world is still way too set up for vertical allocation methodologies. It's already a stretch, I can tell you from our discussions, to get people to think about, on either the public or private side, hey, maybe you should think about investing in fixed income next to equities under one mandate, because it's better for multiple reasons in both areas. That is already a big stretch given how institutional investors are set up, but it would be, to my mind, by far a better way to invest in emerging markets.
And you mentioned India, Brazil, Vietnam. I mean, let's go through some of those. I mean, what do you think about the India thesis? Because many people say India is the next China. Obviously, public markets have done very well there recently. Growth has been incredibly strong, so it seems like it's a good story. What do you think?
It is a good story. It's got scale. It's got a plethora of private companies. It's got functioning capital markets. It has got rule of law. It's got the English language. It has got a lot. And the government policies and actions have been very business friendly over the last several years. So I think to say that it's the next China is kind of reductive, right? It's not the next China, it's India. That's what it is. And it's got different issues and different possibilities, but it is a massive country that is very important on the global stage. As you would say for Brazil for different reasons, as you would say for some other countries. So yeah, the India story is important. How you approach it, again, you have to take into account local vagaries. You have to be local. You have to have local relationships. And despite the fact that it has got a big capital market, you should not be depending on IPOs as your way out of investing on the private side. On the public market side, there are literally thousands of equity tickers to look at in India. And so you can fashion a strategy that is a small cap strategy. You can have one that is a mid cap strategy. You can have one that is sector focused, very similar to how one slices up looking at equities elsewhere.
I mean, do you worry about valuations in India? It seems like there's obviously been lots of attention paid to India. Valuations look quite stretched. Does that concern you?
Not as a long-term EM guy, in the sense that valuations come and go, levels rise and fall. Of course, there is a herd mentality in the world of investing when things get fashionable, as you say, whether it's India or Nvidia. I'm not trying to be poetic here. It happens, right? We've seen it happen in developed markets. We'll see it happen in emerging markets. It will come and it will go. But a country the size of India, the market cap that is involved, it's not going anywhere.
And are there certain countries you feel people aren't focusing enough on? So, Vietnam, Brazil, Indonesia, these are some of the ones that people often talk about as sort of the next big things. Are there certain other countries that you feel, should be, people should pay more attention to?
Look, I think if you think about sort of whether it's at the country level or the asset class level, the big themes that are at work in the world today of interest rates staying higher, geopolitical risk and competition existing, these themes play out in different ways in different countries and different asset classes. So let's take geopolitical competition, which we all now, I think, accept as a fact of life. So one of the implications is the whole nearshoring, friendshoring, supply chain implication. And that in Asia would get you Korea, for instance. It would get you Vietnam a little bit. In this time zone, it's going to get the US time zone. It's going to get you Mexico, right? Mexico is a darling for, among other reasons, this nearshoring thematic. You look at higher interest rates. Higher interest rates means higher carry in emerging markets, in emerging market securities, because they've always been at a premium in terms of rates relative to developed market fixed income. So that gets you the fixed income asset class. It gets you private credit in emerging markets, which is yielding very fancy rates of returns in dollars, what have you. So it's really about sort of looking at how these trends, which we all accept as global trends, play out in emerging markets, rather than thinking about emerging markets as an asset class, what have you. And the last thing I would say here is because things are so idiosyncratic in emerging markets, it would be a big mistake to think of it as one thing these days. There are so many sort of turnaround stories in emerging markets, or potential turnaround stories. People talk about Venezuela when and if they lift the sanctions. People talk about Argentina 3 months down the road, 6 months down the road, if Milei can make these reforms stick. People talk about South Africa, sort of hidden reality that the electricity shortage there is being dealt with by the private sector as opposed to Eskom, and will be resolved by the end of this year. So there are a lot of these kind of idiosyncratic one-off stories. People talk about Turkey, same thing. What's the direction of that economy post-election? And those stories are taking place on pretty decent-sized economies, right? Most of the names I just mentioned are pretty good-sized economies, let alone, as I say, a Brazil or an Indonesia. So there's a lot to look at in EM.
And speaking of themes, I speak to lots of investors, around the world, and of course, inflation has been a big question in recent years, especially from asset allocators. How do you hedge against inflation? They have large allocation to bonds, which obviously isn't necessarily the right hedge for this type of regime. It strikes me that in the EM world, you could actually construct a much more effective forms of hedges against inflation. So how do you think about something like that through your lens?
So in EM and elsewhere, EM, as you say, does have a few interesting inflation-linked alternatives. So one of the things people don't actually follow much is the inflation-linked bond market in emerging markets. The version of TIPS or European TIPS is inflation-linked bonds in about 15 countries in EM. It's about a $500 billion marketplace. The linkers in emerging markets are typically driven by headline inflation as opposed to core inflation. They typically have more food and energy as part of the calculation. So it captures inflation on the way up faster than linkers in developed markets. At the same time, emerging economies, because they tend to be dominated by a small number of large companies, do not pass through deflation nearly as quickly as would be the case in developed economies. So you have this asymmetry on top of these higher rates with emerging market linkers. And emerging market linkers are legitimately complicated to understand and execute. So you have a complexity discount. So emerging market linkers is one thing. And things like infrastructure, which is a huge asset class in EM and a necessary asset class in EM, will offer inflation protection as well. And then we have real assets in the form of forestry and agriculture, which we at TRG invest in on a global basis, not by any means exclusively to emerging markets. And those are areas that have more than just an inflation component, right? They have in agriculture, the food security component, the local labor component, sustainability. Forestry, of course, has this huge carbon element and is benefiting from a new set of investors coming into that area of investing, namely corporates who are trying to achieve their net zero commitments and who know they can't do it by just reducing their footprint. They have to actually deploy cash into forestry to get the carbon credits to get to their net zero calculation. So you do have these other ways of managing inflation risk via emerging markets. So again, it's a global theme. How do you manage it via emerging markets as opposed to it's an emerging market theme, if you see what I mean?
Understood. And in terms of themes, how about another one, demography? This is something where we're seeing interesting dynamics around the world, including the US now, of an aging population. Europe, of course, is heavily aging. Japan, it's probably most advanced in that sense. How could you construct something to capture shifts in demography?
It's a hard question to answer beyond just exposure to emerging markets in general. As you say, these are the demographic dynamic, generally speaking, in EM. We are definitely not talking about China here for this point, are much healthier than they are in developed markets. And so this is going to show up globally speaking. Of course, there are things that younger people will tend to consume more than older people, what have you. So you can try to get exposure to the consumer sector. Healthcare is more prevalent for aging population as a necessity than for younger populations. But in general, I would just call it an EM theme, broadly speaking, Gilad.
Yeah. And then something like AI, obviously this has been a big story for the past year and a half.
Mhm.
You mentioned NVIDIA earlier. How do you think AI will affect your portfolio, and just how do you think about something like this? We had .com in the 90s. Now it seems like
Right.
AI is a new big thing.
Yeah. I don't know is the short answer. And how it will affect our business versus how it will affect our portfolio are two totally different things, right? So how it will affect our business, I think more straightforward. We can write our newsletters more efficiently. We can answer client queries more efficiently. Presumably one can train up ChatGPT and others along those lines to do a credible job or an 80% job along those lines. We'll see about how it works on sifting through information that is relevant to investment decision making, but certainly in terms of managing the ins and outs of a business like ours, it should have a role. Generally speaking, all things technology get reflected in EM over time, but it's really over time because the large technology firms, the large fintech firms, the large tech-enabled firms are, and investing firms too. So I think about quants, for instance, are much more obsessed about getting bigger, faster, deeper in the big markets than they are about getting broader into our markets. So what you tend to see in EM is the copycat of Amazon, the copycat of a fintech, the copycat of of Google, what have you, being built in a smaller economy, in a 50 million population economy, and then looking to be sold to the big guys eventually.
Okay. And in terms of risk management, I mean, every investor worries about risk management. And then you mentioned some things earlier about local knowledge is very important. What are your broad principles about how you manage risks in your portfolio? Because it sounds like compared to somebody who's largely has DM assets, where they think about stop losses, VAR, and those sorts of things, you have an extra few layers of complexity that
Yes.
they wouldn't have.
Yes, very much so. And it's different on the public side than it is on the private side. On the public side, of course, you come out of a bank, you're all trained up in value at risk, and I can reduce everything to one number, and that number means everything, and that number is going to give me a 95% certainty that I will never make or lose more money than this on a given day. Eventually, you learn that you have a 1,000-year event every couple of years, so you get disillusioned a little bit on that. And then you apply it to EM, and EM has had so many binary one-off crises. You mentioned a couple of them: Mexico 94, Russia 98, Korea 98. So what we do on the public market side is we keep a tab of about 15 emerging market crises and how those played out in the immediate aftermath across all of the asset classes. And we run all of our portfolios through all of these crises on a daily basis just to have an idea. And so that's where you end up with, oh, okay, if I have Russia 98 for this particular portfolio, that's going to be a 17% drawdown kind of thing. We don't then put limits because that's you're talking about a binary hypothetical and saying, oh, well, I want my Russia drawdown limit to be 15% instead of 17. I think that's unrealistic. It's more about just let's understand that if it is a Russia crisis, which was a default on local T-bills, if it's that kind of thing, then this is the likely path of the problem. If it is a Mexico 94, which is a currency deval, it's this kind of problem and it will spread out that way. So that's on the public market side. On the private market side, what I have found is, in general, private market investors, be it private equity or private credit, to be blunt, I don't think they do a lot of risk management, right? They get the investors to say, we don't want you to worry about currency risk because it's long-term and you can't hedge it, et cetera, et cetera. And what we have tried to do is bring an element of discipline across our private market investments in which we track both exogenous and endogenous factors that have to do with how a private investment is performing relative to its original thesis. You know, are we getting volume growth for this producer of XYZ? Are we seeing multiple growth for this industry among its peers? How's the currency doing? How are rates doing? And we simply track those literally on a green, yellow, red basis below, right? And I have a heat map where I basically can look at these traffic lights across all of our investments and simply visually see, where do I have a problem? Where do I not have a problem? And having that heat map is as close as we're going to get to reducing something to a value or risk notion for the private side. And I think it's taken a lot of work. It's taken a lot of time for us to get to this point. But I'm very happy with that approach. And I feel like it kind of captures the best of both worlds.
And then what makes you most excited about EM and your markets that you look at?
I think that emerging markets, I've always said, if you're the best bond trader in the world, you're not going to work in emerging markets. You're going to work in the big markets. If you're the best FX trader in the world, similarly. People work in emerging markets because they love the subject matter. They don't work in emerging markets because they love bond trading. And there is a collegiality and an esprit de corps a little bit amongst the industry that I just think is different than the same thing in developed markets. People understand in emerging markets intuitively that we are impact investors and that we are having an impact on the world. It's not in the strict definition. It's not in the, standards of reporting, what have you, but it is just intuitive that if you are helping companies in these countries, if you are buying and selling bonds from these countries, you are sending signals and sending help to parts of the world that can use it to greater effect than will be the case if you are with no disrespect, some mid-market buyout person here in the US.
No, that's great. No, that's, I can see the real sort of passion and love you have for EM, which really sort of comes through. That's really nice to see. Now, I did want to round off our conversation with just a few personal questions.
Yeah.
One was, what's the best investment advice you've ever received from somebody else?
I actually have, I know you were going to ask that question. I've been racking my brain, Bilal, for an answer. I don't have a direct answer to your question. My observation, or the things I have taken from people I've admired in our industry, is mostly about keeping calm and carrying on, and not getting too high and not getting too low, and keeping your eye on the prize and treating people well. So that has been enormously important to me in terms of how I built the business and how I act and how I behave in the industry. And that's really what I have sort of hung my hat on. Here at TRG, I do not manage the money at TRG. I have 18 partners here in the firm, in a firm of 160 people. Of those 18 partners, probably 14 are directly on the investment side. And they and their colleagues, the other 55 investment professionals here, are the ones who manage the money. I am trying to build a system in which they operate, in which they thrive, but which they are also continually feeding back into and improving through their efforts.
Yeah, that's great. The other question I wanted to ask was about students. We do have some students who are listening to this podcast, and many of them will be leaving university at some point this year to enter the real world. What advice would you give to youngsters as they enter the real world?
So I think there are a few bits, and I'm leaning here on what I used to do at JP Morgan, which was they would trot us out in front of the training program every year. Probably you went through a different training program than I went through, Bilal, because you came later. When I started at the bank, it was an 8-month academic training program. We sat in a classroom for 8 months, and mostly we studied accounting, which was pretty boring stuff. But we would roll through people from the bank to the training program to spend an hour or two talking about their particular area. And it would all start with, tell us about your journey in the bank. And mine over time evolved into how to manage your career. So here is my career management advice to your audience. Number one is follow your happiness. I find that young people today overanalyze things to an extent that is kind of surprising, as opposed to look in the mirror, understand who you are. Are you a people person? Maybe you should be on the sales side of finance. Are you a deep thinker? Maybe you should be in research. Are you a trader, and are you a hyper competitive person and you only want to win at all costs? You should be on the trading side. Understand how the way you are wired should imply the direction you should take, number one. Number two, this issue of happiness is very important over the medium term. So if you are in a role that does not reward you, does not bring you happiness, literally, where you are kind of slogging away at it, and you don't see that changing for the foreseeable future, then you should change that role or change from that firm. Of course, we all have 6-month windows where we're not happy, but if you cannot see that over 2 or 3 years you are going to be happy, then you need to change. So that's number two. Number three is I'm half French. One of the reasons I like EM is it's international, right? So I speak French and I speak Spanish. À moi l'aventure. I don't know if which translates into be adventurous and take the path that is not taken. And particularly for young people, it's a truism, like you should take more risk when you're young. And by the way, if you are from a well-off family, you should take even more risk because you have different insurance than lots of people. I went to Japan when we had 5 people in Japan. I was rewarded from that by being able to choose what I wanted to do next. And I took another huge risk. I traded down career-wise to do this emerging market thing. I was managing 50 people in Tokyo. I was managing 8 in New York. I took that risk. I built that up. And the taking risks and taking the path not trod works for some people. So à moi l'aventure is the next item. The fourth is, and this comes back to the don't overanalyze stuff. My fourth note was, don't worry about the weather, which really means only focus on things that are in your control. When you're young and you're starting your career, you tend to get obsessed about the direction of this firm or what XYZ MD is doing or what the vice chairman is saying. And the truth is, none of them give a shit about your opinion on this, right? And it's a waste of time and energy. Focus on the things you can focus on. And then I think I had two other bits. One was nobody cares about you but you. So it is your responsibility to manage your career. If you think that your boss is going to manage your career or the HR person is going to manage your career or anybody else, that is largely not true. It will be true to a small extent, but it is largely not true. So take responsibility for the direction of your career. And the last thing, which I learned from observation, was just because a jerk becomes an MD doesn't mean you have to be a jerk to be an MD. And so behavior has consequences. That's over time. So those are my canned bits of advice for young people.
No, they're fantastic. I really like them. I jotted them all down while you were speaking, so I really appreciate that. I did want to ask you a question on books. And what are some of the books that have influenced you, or maybe even books you've read recently that you've really enjoyed?
So it's a difficult topic because I spend so much time reading on this computer that books do not play a huge role in my life. There is one on trees that is called The Hidden Life of Trees. That is a fascinating read about trees literally communicating with each other, communicating stress to each other, all kinds of stuff, which I passed around to my forestry colleagues, and they all said they had never read a book on trees like that. So that's one. There is one that I'm actually scared to read right now, which my brother just sent me. Keep in mind, I travel 250,000 miles a year, 10 times around the globe every year. I'm on a plane a week to 10 days a month. And there is a book now called, I think I have it here. It's called Flying Blind. And it is about the whistleblowers at Boeing. And my brother, who lives in France, does not travel nearly as much as I do, thinks we should never, ever get on a Boeing plane. And after reading that book, I'm worried that I'm going to have the same conclusion. But I don't have a choice in terms of these things, given how often I travel. So I'm a little worried about that one. But those would be two that I would mention.
They're both two great recommendations, and you're quite different from other guests, which is great. So, and I'll add them to my reading list for my next reads. So just finally, what's the best way for people to follow you, learn more about TRG? What's the best way for people to do that?
So we have redone our website, our public website. I think it's quite good and fairly informative. We are also on LinkedIn. And look, obviously, they just need to listen to Macro Hive. It's so obvious, Bilal. So let's just put that out there.
Yeah, that's excellent. I'll include the links in the show note to the website and LinkedIn as well. So with that, thanks a lot, Nick. I learned a lot. It's been fantastic speaking to you, and good luck with all your endeavors.
All right. Thank you, Bilal, and best of luck to you and to all of your audience.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.